What if the next massive move in gold price and silver price happens before the weekend? Right now, the world is facing two powerful catalysts: rising Iran war tensions and a critical Supreme Court tariff ruling that could shake the US dollar. Military assets, including the USS Abraham Lincoln and USS Gerald R. Ford, are positioned near Iran. At the same time, legal decisions in Washington could reshape trade policy and inflation expectations overnight. This is not normal market noise. When geopolitics and economic policy collide, precious metals markets react fast. Oil prices, inflation fears, safe haven demand, and dollar strength are all connected, and gold and silver sit at the center of it all. In this breakdown, we will explain exactly what is happening, why it matters, and how it could impact your portfolio. What if the biggest move in gold price and silver price this year happens in the next 72 hours? Not because of inflation data, not because of interest rates, not because of a Federal Reserve speech, but because of war. Right now, the United States is positioned closer to direct military action against Iran than most people realize. At the same time, the Supreme Court is preparing to rule on tariffs that directly affect inflation, the dollar, and global trade. These two forces are moving toward each other in the same narrow time window. And when geopolitics and economics collide like this, precious metals do not stay quiet. According to reports from CNN, US military options against Iran are actively prepared. Axios cited senior officials suggesting a very high probability of kinetic action in the coming weeks. Meanwhile, former President Donald Trump publicly stated he would decide within days whether to strike Iran. This is not random political noise. This is strategic positioning. Two major aircraft carriers, the USS Abraham Lincoln and the USS Gerald R. Ford, are stationed within operational range. Strategic bombers are deployed. Missile defense systems are active across the region. That level of military buildup is not for headlines. It is for readiness. Now let's connect this directly to the precious metals market. Iran sits next to the Strait of Hormuz. Around 20% of global oil supply flows through that narrow passage. If conflict disrupts shipping there, oil prices could spike immediately. When oil rises sharply, inflation expectations rise with it. When inflation expectations rise, investors look for protection. Gold has always been viewed as a safe haven asset. Silver acts both as a safe haven and as an industrial metal. In times of crisis, both can move aggressively. But here is where it gets complicated. The Supreme Court may soon rule on whether certain tariffs were legally imposed. If those tariffs are struck down, trade costs could fall in the short term. A stronger dollar could follow. And when the dollar strengthens, gold and silver often pull back. So we have two powerful forces, or risk pushing metals higher. Tariff reversal potentially pushing metals lower. Both may unfold within days of each other. This creates one of the most unpredictable setups we have seen in the gold and silver market in years. Investors are trying to price in geopolitical risk and legal uncertainty at the same time. Gold is already near historic highs. Silver has climbed significantly compared to recent years. Markets are not cheap. That means any shock, positive or negative, can trigger large moves. Here is the key point. When military action begins, markets do not give you time to prepare. Futures react instantly. Prices gap overnight. Retail investors wake up to a chart that has already moved. If strikes occur, you will not have the luxury of slowly building a position. The move will already be happening. On the other hand, if a surprise diplomatic breakthrough is announced, risk appetite could return quickly. Metals could face short-term selling pressure before the longer-term story reasserts itself. This is not a normal environment. This is a high volatility moment. In the next chapter, we will break down the military setup in simple terms and explain why this situation may be more serious than it appears on the surface. Because if this is not just leverage, but preparation, then gold and silver may be on the edge of a move that shocks even experienced investors. And by the time confirmation arrives, it may already be too late to react. Because when volatility hits, being prepared is everything. Let's move past the headlines and look at the structure of what is happening. Governments do not casually deploy to aircraft carrier strike groups into a sensitive region. That level of mobilization requires planning, logistics, fuel supply, intelligence coordination, and political approval. It is expensive, it is visible, and it sends a message. The USS Abraham Lincoln is already positioned within operational range. The USS Gerald R. Ford, one of the most advanced carriers in the world, has also been moved toward the region. Each carrier strike group includes destroyers, cruisers, submarines, and air wings capable of launching sustained operations. This is not symbolic diplomacy. This is operational readiness. Now let's connect this directly to the precious metals market. Iran sits next to the Strait of Hormuz. Around 20% of global oil supply flows through that narrow passage. If conflict disrupts shipping there, oil prices could spike immediately. When oil rises sharply, inflation expectations rise with it. When inflation expectations rise, investors look for protection. Gold has always been viewed as a safe haven asset. Silver acts both as a safe haven and as an industrial metal. In times of crisis, both can move aggressively. But here is where it gets complicated. The Supreme Court may soon rule on whether certain tariffs were legally imposed. If those tariffs are struck down, trade costs could fall in the short term. A stronger dollar could follow, and when the dollar strengthens, gold and silver often pull back. So we have two powerful forces: war risk pushing metals higher, tariff reversal potentially pushing metals lower. Both may unfold within days of each other. This creates one of the most unpredictable setups we have seen in the gold and silver market in years. Investors are trying to price in geopolitical risk and legal uncertainty at the same time. Gold is already near historic highs. Silver has climbed significantly compared to recent years. Markets are not cheap. That means any shock, positive or negative, can trigger large moves. Here is the key point. When military action begins, markets do not give you time to prepare. Futures react instantly. Prices gap overnight. Retail investors wake up to a chart that has already moved. If strikes occur, you will not have the luxury of slowly building a position. A move will already be happening. On the other hand, if a surprise diplomatic breakthrough is announced, risk appetite could return quickly. Metals could face short-term selling pressure before the longer-term story reasserts itself. This is not a normal environment. This is a high volatility moment. In the next chapter, we will break down the military setup in simple terms and explain why this situation may be more serious than it appears on the surface. Because if this is not just leverage, but preparation, then gold and silver may be on the edge of a move that shocks even experienced investors. And by the time confirmation arrives, it may already be too late to react. Because when volatility hits, being prepared is everything. Let's move past the headlines and look at the structure of what is happening. Governments do not casually deploy to aircraft carrier strike groups into a sensitive region. That level of mobilization requires planning, logistics, fuel supply, intelligence coordination, and political approval. It is expensive, it is visible, and it sends a message. The USS Abraham Lincoln is already positioned within operational range. The USS Gerald R. Ford, one of the most advanced carriers in the world, has also been moved toward the region. Each carrier strike group includes destroyers, cruisers, submarines, and air wings capable of launching sustained operations. This is not symbolic diplomacy. This is operational readiness. Strategic bombers have been stationed at regional air bases. Missile defense systems such as Patriot and Fade batteries are active across nearby allied countries. Cargo aircraft have been delivering equipment and supplies for weeks. These are the details that matter because they show preparation, not just political messaging. Now ask yourself a simple question. Why assemble this scale of force if you are not prepared to use it? At the same time, Iran has not publicly agreed to permanently halt uranium enrichment or dismantle its missile program. Negotiations have taken place, but no breakthrough has been confirmed. Statements from Tehran suggest resistance rather than concession. This creates a dangerous gap between demands and acceptance, and here's where the tension increases. Russia and China have conducted joint naval exercises with Iran in nearby waters. Even if they do not directly intervene, their presence complicates the situation. It increases the risk of miscalculation. Military planners must account for additional ships, radar systems, and political consequences. One accident, one radar misinterpretation, one missile traveling too close to the wrong vessel. Markets would not wait for clarification. They would react immediately. Now let's connect this clearly to gold and silver. Energy is the foundation of global economics. Roughly 1/5 of the world's oil moves through the Strait of Hormuz. If conflict disrupts that flow, oil prices could surge sharply within hours. When oil spikes, transportation costs rise, food distribution costs rise, manufacturing becomes more expensive, inflation spreads quickly when energy costs increase. Gold price historically reacts strongly to rising inflation expectations and geopolitical risk. Investors seek safety when uncertainty grows. Silver price reacts not only to safe haven demand, but also to industrial needs. If governments increase defense production and infrastructure spending during conflict, silver demand can rise from multiple directions. But here is the psychological factor. Right now, markets appear relatively calm. Stock indices are not collapsing. Oil has not exploded yet. Gold and silver have not doubled overnight. That calm can create a false sense of security. Historically, geopolitical escalations often move from quiet build-up to sudden action. The shift from preparation to execution is rarely gradual. It is often abrupt. If airstrikes begin, futures markets could react within minutes. By the time retail investors log into their accounts, the price move may already be well underway. This is why tension is building. We have visible military positioning. We have unresolved diplomatic talks. We have major global powers nearby. We have oil supply risk. And we have investors trying to decide whether this is leverage for negotiation or preparation for real conflict. Because if it is leverage, metals may experience short-term volatility, but stabilize. If it is preparation, the next chapter in gold and silver could be explosive. And just as this geopolitical tension reaches a peak, another variable is about to enter the equation, the Supreme Court ruling on tariffs. In the next chapter, we will break down how that legal decision could temporarily push metals in the opposite direction, and why the combination of war risk and trade policy uncertainty makes this moment uniquely volatile. While military ships move into position in the Middle East, something equally important is happening in Washington. The Supreme Court is reviewing the legality of major tariffs imposed under emergency economic powers. These tariffs affected imports from multiple countries and generated billions in government revenue. They also increased costs for businesses and consumers, adding pressure to inflation. This legal decision may not involve missiles or aircraft carriers, but it directly affects the gold price, silver price, the US dollar, and inflation expectations. If the court rules that the tariffs were imposed illegally, it could create short-term economic ripple effects. Investors may interpret that ruling as reducing trade tensions and lowering cost pressures. A reduction in tariff-driven inflation could strengthen the dollar in the short term. And when the dollar strengthens, precious metals often face downward pressure. Gold is priced globally in dollars. When the dollar rises, gold becomes more expensive for foreign buyers. That can temporarily reduce demand. Silver often follows the same pattern. So now we have a situation where war risk may push metals up, while a tariff reversal may push them down. This is where the story becomes more complex. Let's break it into clear possibilities. Scenario 1. War begins and tariffs are upheld. That combination would likely be strongly bullish for gold and silver. Scenario 2. War begins but tariffs are struck down. In this case, geopolitical fear may overpower trade relief. War tends to dominate market psychology. Safe haven demand could still push metals higher, though price swings might be volatile. Scenario 3. Diplomacy succeeds and tariffs are upheld. If a deal with Iran reduces geopolitical risk, but tariffs remain, metals may stabilize. Inflation would still exist, but without the additional war premium. Scenario 4. Diplomacy succeeds and tariffs are struck down. This is the most bearish short-term case for gold and silver. War fears fade. Trade costs drop. The dollar strengthens. Risk appetite returns. However, even this scenario has limits. Global debt levels remain extremely high. Central banks continue to accumulate gold as part of their reserves. Inflation has not disappeared from the global system. Structural issues in supply chains and energy markets still exist. That means even the most negative short-term outcome for precious metals may not change the broader long-term trend. But here is what makes this moment unique. Normally, markets deal with one dominant theme at a time. Either it is inflation, or recession, or war, or trade policy. Right now, two major themes are colliding in the same week. Investors must process military escalation risk and a potentially historic legal ruling at the same time. That creates confusion, and confusion creates volatility. Volatility is not always gradual. It can appear suddenly. A court decision could hit headlines during market hours. A military strike could occur overnight. Oil prices could spike before investors even have time to analyze the news. This environment rewards preparation, not reaction. Because once the narrative becomes clear, Prices may already reflect it. The big question now is this: which force will dominate? Will it be economic relief from tariff changes, or geopolitical shock from military escalation? In the next chapter, we will look at historical patterns during wartime and economic uncertainty. We will examine how gold and silver have behaved during past conflicts and why this time may move even faster than many expect. Because if history offers any lesson, it is this: when uncertainty multiplies, precious metals rarely stay still. Now we reach the most important part of this entire analysis. What actually happens to gold and silver when real conflict begins? History gives us clues, and those clues are not subtle. When major geopolitical conflicts break out, markets do not move slowly. They react instantly. Oil jumps first. Energy traders price in disruption within minutes. Then inflation expectations rise. Bond yields adjust. Currency markets shift. And very quickly, safe haven assets begin to move. Gold has historically responded to war for three simple reasons. War increases uncertainty. War increases government spending and debt. War increases inflation risk, especially when oil supply is involved. All three factors support higher gold prices. Silver behaves differently, but often more dramatically. It is both a monetary metal and an industrial metal. During conflict, industrial demand tied to defense production and infrastructure can increase. At the same time, investors treat silver as a lower-cost alternative to gold, creating additional buying pressure. Now bring the current situation into focus. If military strikes occur near Iran and the Strait of Hormuz is threatened, oil prices could surge sharply. Even temporary disruption to that shipping lane could send global crude markets into panic mode. Energy costs feed directly into transportation, food production, manufacturing, and electricity. That is how inflation spreads rapidly, and inflation changes central bank behavior. Policymakers face a difficult choice: raise interest rates and risk recession, or tolerate higher inflation and protect growth. Either choice creates uncertainty. Uncertainty is fuel for precious metals. But here is what many investors underestimate: speed. Modern markets operate on algorithms and high-frequency trading systems. The moment verified reports of strikes hit newswires, futures contracts react. Gold and silver can move several percentage points in minutes. Oil can gap before retail traders even open their trading apps. There is rarely a calm window to think it over. Now consider the alternative. If a sudden diplomatic agreement is announced, perhaps through last-minute negotiations, markets could flip into risk-on mode. Oil might pull back. Stocks could rally. The dollar could strengthen. In that scenario, gold and silver might experience a sharp but temporary correction. Notice the pattern. Both outcomes involve volatility. This is not a slow, steady environment. This is a catalyst-driven setup. Another important factor is positioning. Gold is already trading near historic highs. Silver has climbed significantly compared to previous years. When assets are elevated, reactions to news can be amplified in both directions. If war begins, we could see acceleration upward. If diplomacy succeeds, we could see fast profit taking. The key point is that this moment represents a peak of tension. We have visible military readiness. We have unresolved negotiations. We have oil supply vulnerability. We have a pending Supreme Court tariff decision. These forces are overlapping. Markets do not like overlapping uncertainty. They respond with sharp price discovery. And here is the real climax question. Is the military build-up leverage for negotiation, or is it preparation for action? If it is leverage, we may see temporary spikes followed by stabilization. If it is preparation, the repricing in gold and silver could be powerful and fast. In the final chapter, we will move from analysis to action. We will translate these scenarios into practical thinking so you can approach the next few days with clarity instead of emotion. Because in moments like this, preparation is more valuable than prediction. Let's bring everything together, clearly and calmly. We are looking at a rare moment where geopolitical risk and economic policy risk are colliding at the same time. On one side, there is visible US military positioning near Iran. Carrier strike groups, bombers, and missile systems are not rumors, they are real deployments. The possibility of conflict affecting the Strait of Hormuz is not theoretical. Roughly 20% of global oil supply moves through that narrow waterway. Any disruption there would immediately impact oil prices, inflation expectations, and global markets. On the other side, there is a Supreme Court decision regarding tariffs. That ruling could influence trade costs, inflation pressure, and the strength of the US dollar. A stronger dollar often pressures gold price and silver price in the short term. A weaker dollar often supports them. So we are not facing a single catalyst. We are facing overlapping catalysts. Let's simplify the 4 possible outcomes again, but this time from a practical perspective. If war begins and tariffs remain in place, inflation pressure could rise from both oil and trade. That is the most bullish environment for precious metals. Gold could push 2 new highs. Silver could experience sharp upside volatility. If war begins but tariffs are struck down, geopolitical fear may still dominate. Safe haven demand could outweigh trade relief. Metals may rise, though price swings could be dramatic. If diplomacy succeeds and tariffs remain, metals may consolidate. Inflation would still exist, but without the additional war premium. If diplomacy succeeds and tariffs are struck down, that creates the most short-term downside pressure. War fears fade. Trade costs drop. The dollar strengthens. Metals could correct. But here is the deeper truth. Even in the most negative short-term case, structural factors remain in place. Global debt levels are elevated. Central banks around the world continue accumulating gold reserves. Inflation has cooled from its peaks, but has not disappeared. Energy markets remain sensitive to geopolitical events. Those long-term drivers do not vanish overnight because of a single ruling or press conference. This is why emotional reactions can be dangerous. If you already hold physical gold or silver, remember why you hold it. Precious metals are insurance against instability. They are not meant to perform perfectly every week. They are meant to protect purchasing power during uncertain periods. If you are considering entering the market, understand that timing headline-driven volatility perfectly is extremely difficult. Markets often move before clarity arrives. Waiting for complete certainty usually means entering at a higher price. If you trade paper, metals, or short-term instruments, recognize that volatility can expand quickly. Price swings may be larger than usual. Risk management becomes more important in high uncertainty environments. The most important takeaway is preparation. Look at the scenarios. Decide which outcome you believe is most likely. Assess your risk tolerance. Build a strategy based on probabilities, not fear. Because here is the reality. If military escalation occurs, the move in gold and silver could happen overnight. If diplomacy succeeds, volatility may still shake markets before stability returns. If the Supreme Court ruling surprises investors, currency markets could shift quickly. This is not a quiet period. This is a convergence moment. And convergence moments often define entire market cycles. Now the question shifts to you. Do you believe geopolitical risk will escalate? Do you believe trade policy will change? Do you believe inflation will reaccelerate or cool? Your answers shape your positioning. The next few days may not just move charts. They may redefine the narrative around precious metals for months or even years. Stay alert. Think in probabilities. Avoid emotional decisions. Because when uncertainty multiplies, preparation becomes your greatest advantage. The next few days could redefine the direction of gold, silver, oil prices, and the US dollar. Whether it's military escalation near Iran or a surprise Supreme Court ruling on tariffs, markets are entering a high volatility phase. Safe haven assets like gold and silver often move before most investors fully understand what's happening. The key is preparation, not panic. Watch oil. Watch the dollar. Watch geopolitical headlines. These signals will likely determine the next major move in the precious metals market. If you found this analysis valuable, share it with someone who owns gold or silver and needs to understand what's unfolding. Drop your thoughts in the comments. Do you expect war, escalation, or a diplomatic breakthrough? Subscribe and stay informed. Because in markets driven by uncertainty, those who move early usually move best.